Okay, this is another important concept that you should adopt, I think, no matter what kind of technique that you use. When you're looking at charts, and let's say you've decided to make wave charts a regular part of your analytical process. If you're looking at a chart that looks like this and has hundreds possibly of monowaves on it, that's way too much subdivision to arrive at a reliable conclusion. Wave theory depends on limits imposed on everything, so that you want to have limits on how much information you analyze at any one time, along with lots of other things. But the ideal time frame, if you can just visually get used to this, and maybe you can refer to it over time, the ideal time frame is indicated by diagram A and diagram E. Those are pretty much the range of complexity that you should see on a chart. If it's anything like this or like this, that's presenting you with too much information. It makes it very difficult to come to accurate conclusions. And this small amount of information, and this especially, is not enough to arrive at any kind of conclusion. So your complexity of your chart has to fall into a particular range to arrive at accurate conclusions. So what does this mean? Let's say that you're following a chart on a daily basis. It starts looking like this. Well, what you want to do is create a weekly chart of the same time frame so it starts to look like that. And you pay less attention to this daily chart and more attention to the weekly regarding that time frame. And when you're studying the daily, you should start to focus in on a much shorter time frame that you can, once again, analyze. Does that make sense? Okay, let's go to the next chart. Innovation number 3 is what I call self-definition. This is the market defining where you start and stop your patterns, the market defining what constitutes a degree. Most people, if they were to look at this chart, would immediately probably start doing the analysis from this lowest point here. Maybe from the beginning if they're doing just pure mathematical analysis, but if they're doing any kind of overbought, oversold, trend following techniques or whatever, they most likely would start from the lowest low. The problem with that is if you always assume that patterns and trends start from the highest high or the lowest low, you're never going to get the coherent behavior that you need to accurately predict market action. Unfortunately for most of us, I guess as analysts and traders, the markets don't conveniently always terminate patterns right at the top or bottom. The trend, visually speaking, yes, may terminate at that point. But from an analytical standpoint, no matter what kind of technique you use, you need to realize there's certain kinds of behavior that have to happen near a top or a bottom to tell you whether that highest high or some later lower high or some higher low after the low is actually the beginning of the new trend. So let's say you're using an overbought, oversold indicator of some sort. This is the bottom you're using the analysis on. Maybe it indicates it's very oversold, but the trend of the market, a real powerful move, doesn't start until the next higher low. And that's an indication that you're starting your analysis from an improper point. Let's go to the next chart and I'll show you how this is actually determined. When you're attempting to start an analysis process, or it's an ongoing process, you first would find the highest high or lowest low, figure out which direction you're trying to predict. If the market's generally going up, then let's start off the bottom, which in this case it's doing. So first thing you want to do is mentally or actually draw a vertical line right through the bottom of that lowest point. Then you'll want to go backwards to some previous important point. It doesn't matter because everything's relative under the wave theory. So the further back you go, the bigger the degree you're analyzing. So we're just going to go back a short period of time to an important, relatively important high here, market. We're going to call it point A. The distance between the starting line and point A will be called segment A for this purpose. The distance from point A horizontally until it hits the next piece of price action will be called point B. And if you measure the distance between point B and start time, you get segment B. Now what you want to do is you want to compare the time between segment A and segment B. And when you're doing wave analysis or any other kind of analysis, you want to make sure that segment B is always smaller than segment A. If it's not, you're starting your analysis from the wrong place. Okay? Segment B always needs to be smaller or the same size as segment A. It should never be larger. If it's larger, you're starting your analysis from the wrong point, or the market hasn't started a new powerful trend that will create a complete reversal of the previous trend. It may just go sideways or something, but it's not going to do what this did here. So if you can't achieve that kind of a result, you have to keep moving your start timeline, mentally or actually, further and further to the right of the chart until you get to some low where segment B is smaller than segment A. That's where you start your analysis. Yes, this, you can see between here and here, segment A is too small in relation to B, so B is too big. You move it to the next higher low, segment B is now smaller and segment A is larger. So now you can start your analysis from this point. Now, this has a very serious application for NEoWave and Elliott Wave. Yes?
Does that mean for a long consolidation, you'll take the start of the breakout where it jumped out of the box and came back to the top?
It will just, whatever it takes to apply this process, there's no specific rules there. If this process shows that segment B is smaller than segment A, then you're safe to assume you can start at that point, whatever that point happens to be. So this is the market telling you what to do instead of you putting in your own opinion. So obviously it regiments the approach a great deal and avoids a lot of subjectivity. So every one of the NEoWave techniques that I'll talk about today is a step further away from subjectivity and closer to complete technical science. Any other questions about this approach? Yeah, you could have gone to this point here and then drawn it across to whatever point touches horizontally. You want to make sure your line is perfectly horizontal to the next touch point. And like I said earlier, the further back you go, the bigger degree you're analyzing. Any other questions? You have some?
Yesterday, I listened to another Elliott Wave, and supposedly it started when it dropped out of bed.
What started?
The wave started at the bottom.
Here?
Yeah, because that looks like it just went straight down. Dropping out of bed.
From here?
Right.
Okay.
But that is not the start.
Well, as far as the uptrend is concerned, no. It may be the conclusion of the downtrend, but I know from experience, if you want to reach high reliability in your pattern development and your forecasting accuracy and trading accuracy, you have to adopt these approaches. Otherwise, there's going to be a lot of flexibility, and it's going to be up to your opinion and experience, which is something I think you want to, at least I want to avoid, because I don't want to be putting my own emotions into the situation. I want the market